Hi, everyone. Welcome to Accounting Profits and Prosperity. I am your host, Louie Prosperi. I would love to welcome Ron Baker, the author of his latest book, Time's Up, the subscription model for professional firms. It's great to have you, and I'm looking forward to talking to you today on your book.
Oh, thanks for having me, Louie. It's great to be with you.
Let's start off with, first of all, why you did this book. I mean, you've been a value pricer from day one, and all of a sudden you decided, at this stage of my career and where I'm at, let's disrupt the whole organization all over again, and let's introduce subscription modeling to the industry.
Yeah, it's a great question. There's an economic revolution going on, and economic revolutions don't care about your feelings, and they don't care about your prior works. I mean, they're going to sweep over the economy, whether you agree or disagree with them, and I think the subscription economy, which is projected to be $1.5 trillion by 2025, is one of those revolutions. And I think it's an opportunity for us as professionals to up our game. As you know, Louis, I've been fascinated with the question, what would happen if Disney ran accounting firms? It's a fascinating question to think about because I don't think they would view it as a commodity. I think they would plus the offering. I think they'd provide a better customer experience, and they wouldn't see it as a grudge purchase or something that you need to have. They would plus it to the point where you'd be thrilled to pay a higher price for a better overall experience. That's why I wrote the book. I wanted to bring that level of enthusiasm back into our profession.
Well, Ron, when you said Disney doing our profession, I had an image of Mickey Mouse doing taxes.
Right.
So I don't. So that would have been interesting. But I get what you mean, because Disney's been a disruptor and they have a very successful business model. And so let's talk a little bit about one of the things you put in your book. What should professionals be paid for? Right? Because that's something you keep bringing up all the time. For example, what would be the disruptors of our industry?
Another great question. What should we be paid for? That's actually called the revenue model question, which is different from the pricing question. The pricing question asks, how much are we asking the customer to pay? This is asking, what do we want the customer to pay for? Now, traditionally, we've answered that by saying, well, we want them to pay for hours or our inputs. Or when we moved to value pricing or fixed pricing, we said, well, we want them to pay for services, a defined scope of services. And when we moved to value pricing, we wanted to say, well, we'll price the customer depending on the value we create for each one. But that's not how it was implemented in a lot of firms. A lot of firms still priced based on the services provided, a scope of work. Right. What happened was when you offered options, say 3 options, the scope of work would just become greater. So it was like we were piling up, services brick by brick by brick, thinking the more services we provide, the more value we're generating. But I don't think that's true, Louis. I don't think that's true at all. I think what the customer should pay us for is the transformation. And that means guiding the customer from where they are to where they want to be, some desired future state. And we can do that, and we can do it over and over and over again. So accountants have the ability to help their customers' businesses become more valuable, to become more profitable. We have the ability to give our customers more free time from their business to spend with their family, to get their kid into college, to plan their legacy, to build their dream home, whatever it might be. We have these abilities to transform our customers. And when you transform the customer's the product. It's no longer about the services. The services are just a means to an end. And I think we should charge and price for transformations because that is our ultimate value as professionals.
That's interesting. When you talked about transformations, it's actually one of my questions I was going to ask you later. But you brought it up now, so let's do it from here. Like when we talk about transformations, one of the things we talked about is value. Topic to me and you, I know. There's different levels of value. How does transformations rank in the different values? Because there's commodity value and so forth. I think this is relevant to the professionals to understand levels of value.
Yeah, and this comes from a book called The Experience Economy, which was written in 1998 or 9, I think the first edition came out. And I read this back then. I actually read it ahead of time in an HBR article that was based on the book before it came out. And they laid out in this book, The Experience Economy, a hierarchy of value. And they said, if you sell stuff, you're in the commodity business. So you sell wheat, you sell oil, we're pulling it out of the ground or growing it. It's going to eventually become a commodity. You're not going to have much pricing power. How do you decommoditize a commodity? And they said, well, you take different stuff and put it together and create a tangible product. So you take flour, wheat, some other ingredients, and you make bread. What happens when you're good? becomes a commodity. Well, then they said, well, then you start to sell services. So you start to price for the things that you provide to your customer in terms of intangibles. So those are services. When I read that, Louie, I said, well, this is where accountants are in this hierarchy. And then they said, well, what happens when your service becomes a commodity? And then they said, well, then you add an experience. So this is where you charge for the time the customers spend with you. And I don't mean billable hours. I mean like, buying a week pass for your family at Disney World or something. And so you're actually paying to spend time at the parks. Okay, I looked at that and said, well, accountants really can't provide experiences like Disney can. But then there was one more level, because then they asked, well, what happens when your experience becomes a commodity? Been there, done that, got the t-shirt. And then they said, well, then you offer or you guide transformations. And when I read this for the first time, and again, this is like 1997, I'm reading this article, and I'm thinking, oh, geez, we do this every day as accountants. It's just that we don't use the language. We help our customers grow their business. We help them achieve new things in their life. We can transform them as a person, not to mention stuff in their business as well.
Right.
And I read that and I said, we are already in the transformation business. And that is the apogee of their hierarchy of value. Now, the author of this book is a guy named Joseph Pine. And we've had Joe Pine on the radio. And we had him on in 2015. I just looked it up again. We're going to try and get him on again. The reason is he just wrote another article in a Harvard Business Review about the transformation economy. And he called it the new you business model. The new you, meaning we're going to transform you. And gave a lot of great examples. Anyway, when we had him on, I said, Joe, it's been about 20 years since your book came out. Have you given any more thought to maybe what's beyond transformations? And he said, Ron, there is nothing beyond transformations. That's not for us mortals here on earth. He said, the best we can do is guide people to a new desired future state. And I don't think we're doing that as professionals. And that is our full potential. Because if all we're doing for our customers is solving problems, which is fine, and we're good at it and we'll continue to do it and we need to do it. But if that's all we're doing is solving problems, we're just reverting the customer back to the status quo. We're not advancing them. Transformations not only advance them, they change them. And we have the privilege, the sacred privilege of being able to do that. And that's amazing. And that's what I think our customers value in us.
So that's a lot to unpack. So let's talk about transformations for a bit. When we're talking about an accounting professional or a firm or a bookkeeping firm, when we look at transformations, are we looking at not necessarily the services we provide, but the impact on the individual's business and life, right? How it impacts them. Is that correct?
Right. That's right.
When you see accountants and bookkeepers, do they think that way, or do they think more like, I am solving problems? Is that the biggest mindset that has to be switched
Yes.
for our professions today to move? Because technically what you're saying is that they're in the perfect position to be that, but are they that now?
The deep level, knowing that they're professionals and that they're really helping their customers. We all entered this profession to help people. That's the number one reason you became an accountant, a bookkeeper, or whatever. We probably do deep down know that, or at least want to do that. But when you look at our business model, we monetize the service. No matter what we say, we're in a fee for service kind of treadmill. And that's as kind of obnoxious as trading hours for dollars, because it's a hamster wheel that you can never get out of. But when you start focusing on transformations, then your ability to have deeper customer conversations, to ask more beautiful questions, and to have a larger impact on their personal life and their business life, or both, that's really where our value is. And what's amazing about professionals is, since we're not constrained by a product or even services, we can do those transformations over and over and over. And all I think this requires is we need to adopt the language of transformations. That needs to be part of our marketing. That needs to be part of our conversations with our customers. We're not just about the services here. We view the services as a means to an end. The end is a transformation. And I know I've given this example before, Louie, but my landscaper was just here about an hour ago. The guy is slowly upgrading my yard, and the transformation is going to be best curbside appeal in the neighborhood, because he knows I have a goal of selling the house in a few years' time. So he is slowly making this transformation. A transformation doesn't have to be a big grand thing like getting married or, adopting a religion or something like that. It can be something simple as, give me the best curbside appeal, because now I'm not worried about the scope of services. I don't care how he achieves that goal as long as he takes me to that end state. And if my landscaper can do that, then certainly accountants can do it.
So let's talk more about one of the chapters you have in your book, which is called Purpose, Strategy, and Positioning. I really like this chapter because it kind of went beyond just talking about a pricing model. It literally, one of the things that you talk about is, why do you exist? What's your why? It doesn't matter whether you're doing any type of business model, but particularly for subscription models. Why is that so critical for a firm to understand? Why do they exist? What is unique to them? Why is that so important to define?
Yeah, and my co-author, Paul Dunn, whose first 7 chapters really dives deep into the why, the whole purpose thing. But just because I believe people want to do business with people that are aligned with their values, that they believe what the firm believes. And when you have that alignment, it's absolutely magical, because purpose is bigger than tactics. It's bigger than even strategy. It's a choice to pursue your destiny. It's your moral DNA. It's what you believe without even having to think, which is kind of magical. So if you've ever watched Simon Sinek's TED Talk on Start With Why, it's incredible. I would recommend everybody do that. But purpose has been around for quite a while. We all have a deep, meaningful reason to be as human beings, as sentient human beings. And it taps into that, why am I here? Why does this firm exist? What are we trying to accomplish? And what do we believe in? Once you figure out your purpose, then your strategy kicks in, and you have to decide, who are we going to serve? Our strategy is defined by the customers we don't have and the services we don't provide. So think about a general physician. They can only do certain things. They're not going to do surgery. They're not going to try and cure your cancer. They're going to send you to a specialist. They stay in their lane. Their lane's pretty wide, but they stay in it. And when something comes outside of it, they tap into their referral network, their social capital network, to get you to a specialist. It's the same with us. You have to decide whether you want to be a steakhouse, McDonald's, or a vegan restaurant. You can't be all three, because a brand, which is obviously part of your strategy, can only stand for one thing. We can't sell Rolls Royces and Chevys out of the same dealership.
So Ron, that's something that was really unique in the book, and I actually highlighted it because when we talk about purpose and strategy and positioning, what you said is, rather than focusing on what you do, focus on what you don't do. When people try, like in our profession, I think we do everything supposedly, right? Anything under the accounting sun or bookkeeping sun, we do it. It's there, right? But the reality is we don't do everything. And I really love that. Rather than trying to focus on what you do, first start on what you don't do to define you. I thought that was unique because most people don't go with the don'ts. They do the do's first, right? So what made you flip the script on that?
It wasn't me, actually. Read any book on strategy. The classic is Michael Porter from Harvard. He's the one that said a business is defined by what it doesn't do. So it's a classic definition, but I find that as well known as it is amongst, people who talk about it, it's not very well implemented, because you're right. We do try and be everything to everybody. And this is deeper than just, say, picking a niche, although it can be manifested in picking a niche. You could do nothing but dentists or restaurants or whatever it is. But the point is, you have to focus, because strategy is all about trade-offs. Since we can't be all things to all people, we can't make everybody happy. We're not tequila. We have to have these trade-offs. And that's what strategy forces you to do. And then, of course, strategy also dictates your positioning. And your positioning basically is the crosshairs of, you want to be something for someone. You can't be everything to everyone, so you have to be something to someone. And that's your positioning. And again, this kind of goes back to do you want to be a high-end steakhouse? Do you want to be McDonald's? Or do you want to be a vegan restaurant? Those are all very different positioning strategies. Yeah. And the last thing is, you asked why I started with strategy and purpose and positioning, because Louie, I find when we talk about pricing, people want to jump right to the pricing. Well, how do I price this type of customer? My sweet spot of customers, say, are businesses that are $1 to $2 million or whatever it is. But then I have a handful of customers who have $20 million or $50 million businesses, and they require more work, obviously. How am I going to price these, these two segments of customers? To me, that's not even a pricing question. That's a strategy question. You're trying to be a high-end steakhouse, and you're trying to be McDonald's. Pick one. Because I want you to focus. I don't want you to be all over the map. That's a strategy issue. That's not a pricing issue. You shouldn't be pricing something that's not aligned with your purpose and your strategy. That's why the strategy and the purpose and the positioning are senior partners. Pricing is a junior partner. Pricing comes last after you figure out those other three things.
Well, very true, to be quite honest. There was something in your book that you called the attention economy. And when I read that part of the book, one of the things that came up is people say information is valuable or knowledge is valuable. What you refer reference there, it's not the information or the knowledge. It's the attention of the customer that's valuable, is how much is scarce. And to me, that kind of makes sense because the most valuable thing to all of us is our personal time. And you say money follows. Can you explain that a little bit more about what you mean by attention economy for the professional accountant and bookkeeper rather than just in a general sense?
Yeah, the attention economy is fascinating because we are inundated with information, even to some extent knowledge, explicit knowledge that you can get from, say, doing a Google search, or now, of course, using Chat GPT. You might get a little bit more detailed knowledge and even have it written out pretty nicely for you. But what's really scarce is people's attention. What do we pay attention to? And Jason Fried from the software company Basecamp, and I'm going to botch this quotation, but it's something like this. He said, good companies have customers, great companies have fans, but the privileged companies are the ones that have audiences. Because unlike most other companies, I have to pay to get your attention. I have to run an ad on Google or on TV, or I got to pay to get you to give me your eyeballs for a second, 30 seconds, whatever it is. When you have an audience, they give you their attention for free. In fact, they might even pay you for it.
They pay you for it, actually.
I picked this up from George Carlin's autobiography, but George Carlin was a very popular comedian back in the day. And he was driving to a venue one night, and the roads were his driver. It was just a huge traffic jam into the venue. And he had his driver pull off, and he was just sitting there in his car watching people pull into the venue parking lot, get out of their car. They're all dressed up. They're walking in, and he just sat there and he said, oh, geez, they're here for me. They're here for me. I created this huge traffic jam. They're here for me. And that's why it's such a privilege to have an audience, because they're giving their time to you. So here's how I equate that to the accounting profession. If we're going to track time in this profession, and I don't think we need to internally inside of our firms, I think the time we should track is the time we spend with our customers, the time that they, freely sit with us in a meeting or whatever. So that time we should track. And we should also track the time that we save them. How do we free up their calendar so they can do more of what they want to do, spend time with their family, pursue hobbies, whatever it might be. And that's what I mean by the attention economy. Do we have audiences? Because that would be awesome if we did.
That's interesting because that's the last thing we track, right? I don't know anybody that tracks how much time the customer spends with them. And in fact, most firms, and I don't want to be negative on this, but the reality is we have so many customers. We try to minimize that time because of the volume. It's not that we don't want to spend the time with them. We're trying to reduce that time so we can do more work. And what it says here is the exact opposite. The more attention your customer gives you, the more money they're willing to pay. So that's an interesting concept from just doing the work and not seeing the customer, or the customer not paying attention to you. I really like that. I thought that was unique because I didn't see that, to be quite honest. If you've read it, put in your book from other people, this is the first time I've seen it on your book. I thought it was very intuitive for me. Let's go back to some of the old value pricing things, because I think that these are important when we're talking about pricing and we're talking about value. What are the two timeless truths when it comes to valuation? And this is both for value pricing as well as subscription. Can you explain them a little bit to us?
Yes. What I tried to do in the book, I think I have 4 chapters on pricing. What I tried to explain was, if you're value pricing now, or even if you're just hourly billing and you want to learn value pricing, then I tried to lay out 2 chapters. Here are the principles that are the same for both value pricing, business model, and subscription. And then 2 more chapters on what's different in subscription from value pricing. And that's kind of the way I tried to divide that up. So the things that stay the same are these 2 timeless truths. One is all value is subjective. Say a bottle of water. What is a bottle of water worth in terms of its value? Not its cost and not its price, but its value to you. Well, that is heavily contextual. If I'm in the desert and I haven't had water for 4 days, I'll pay anything for that bottle of water. I'll give everything I have and I'll go into debt to pay for it. So it's got a pretty high value. But if I'm washing my dog with the same quantity of water, or my car, well, I'm going to be willing to pay a lot less for it. And if I'm flooded my basement with water, now that water has a negative value. So it's the same product. It's H2O in all 3 categories. How does it go from a really, really high value to a negative value? Accounting can't explain that. Generally accepted accounting principles can't explain that. It's because value is subjective. It's in the hearts and minds of the buyer. It's not dependent upon how many labor hours go into it. It's not dependent on how much profit the companies want to make. It's totally up to the buyer what value to place on something. So that's the first principle, the first timeless truth. The second is all prices are contextual. It's absolutely amazing how much we are influenced by what we compare something to. So what we're willing to pay for something is insanely determined to a large degree by what we compare it to. Like if I said, Louie, would you like to buy my unicorn? Well, you've never bought a unicorn before, so you wouldn't know what to pay for it. So when we have a frame of reference to compare. If anybody's got one of those Keurig coffee machines, where you buy the little coffee pods. What are those pods? They run about 25 cents down here, depending on where you buy. Like if you buy them at Costco, in great bulk. And I know you can pay up to 50 cents, maybe even more. But the point is, you look at the amount of coffee in one of those little pods, it's not a whole lot, but that's not what people are comparing it to. They're comparing it going to Starbucks or Tim Hortons in your case. And they figure, well, that would cost $4, so I'm saving a ton of money. That frame of reference is really important. So that doesn't change in subscription. Those two principles are still true. It's value that determines price, and it's price that justifies the costs that you can incur to have the customer at a profit. And that chain is applicable in both value pricing and subscription. So those things will never change. That's just part of human nature.
I'm so happy to hear that because I'm a value person from day one, and I think the portfolio product as well as the subscription model is really good. When we talk about value pricing, it's more about outcomes or outputs. But subscription modeling is about relationships, which is what you talked about, which really disengages the service from the pricing model. Now, the pricing is no longer tied to the service. Can you explain that a little bit and also indicate why now when you adopt a subscription model, you have to think portfolio rather than customer?
When you're in subscription, you're no longer pricing the customer like you do in value pricing. You're pricing the relationship and you're pricing the portfolio. So you're going to have a portfolio of customers and they're going to require different things at different times, but the emphasis is no longer on the services that we're providing or the scope of services. We're basically, this is where the plus offering comes from. We're giving the customer a better experience. We're giving them peace of mind. We're giving them a frictionless experience, and we're saving them time. We're making it convenient for them. So in my mind, by not focusing on the services, but by communicating to the customer, whatever you need, Mr. or Mrs. Customer, that we're capable of doing. Hence, there's your constraint, right? There's the box that you're in, just like the general physician's not going to do surgery. Whatever you need that we can do, you're covered. Now, when you look at this from a portfolio standpoint, like for instance, if you did IRS audits, well, not all your customers are going to get audited in the same year, right? Only maybe one or two. You can easily spread that across a portfolio. But the reason I like the portfolio approach is because it justifies a higher price. By offering the customer anything they need that we can do, that puts a halo over the value and allows us to up our price. So I think with subscription, you can get pricing power 2 to 3 to 4 times higher than what you're pricing now by focusing on the service.
So, Ron, everybody's just going to focus on the fact that you just told them that they can make 2, 3, 4 times more. Everybody's going to want to adopt the subscription model because of just the rate of return. But there's something in your book that you call it the punch in the gut story that you mentioned in your book. And the value proposition is a plussing with the value proposition or subscription model is key. That story really impacts what relationship pricing is all about.
Yeah, the punch in the gut is very, very difficult for me to talk about because I was the one who was punched in the gut by this. Yeah. But back in the day when I was doing, fixed price agreements and value pricing, I landed an A customer and they were fantastic. Did a lot of work for them, did a lot of consulting work, a lot of high price advisory work that really had a deep impact on their business. And I met with this customer pretty regularly. I mean, we would have these 3-hour lunches and they were located in San Francisco and they were a great customer, but it got to the point where when I put them on a fixed price agreement and I gave them unlimited access, I kind of backed off and said, well, if they need me, they'll call, and I wasn't as proactive as I should have been. I took it for granted. I took the relationship for granted is what I did. And she called me up and said, we haven't heard from you in a couple weeks. And I'm like, yeah, but you have a clause you can call me anytime. What's up? How can I help you? And she says, well, it's not our job to call you. It's your job to call us. And I lost that customer. And this is a grade A, high priced, high value, could have done a lot more stuff with them, and I lost them because I took it for granted. I moved into a cost accountant mindset, Louie, because I'm a recovering cost accountant. I said, customers paying me a lot of money, and They're not using me. What could be better? And you can't have that attitude in subscription. So I'll give you a real quick story. Netflix noticed that about 400,000 people were paying them, whatever it is, $12 or whatever it is per month, and they were never logging in because obviously Netflix can tell. And they sent out an email. I reproduced it in the book. And they said to these 400,000 subscribers, we notice you're not using Netflix. And if you don't re-up or confirm your membership within 30 or 60 days, we're going to cancel you. Now, what would a cost accountant say to that? Here are 400,000 customers paying you $12 a month, and they're never, ever logging into the system, but they continue to pay you. These are dream customers. They're not in subscription.
It's free model. It's free money, right? It's
right. But you can't have that attitude. You have to be proactive. So my North Star for this book was the direct primary care physician doctors here in the United States. There's also concierge doctors, and they go after different price points is what the difference is and the number of patients that they handle. But the point is the direct primary care doctors tell their patients, you subscribe to us, our practice, and we will do anything that we're capable of doing as primary care physicians. They don't take insurance, so they have none of the back office bureaucracy that doesn't add any value to the relationship. And I looked at that model, which has been proven since 1996, by the way. So we have a long empirical track record of how well customers are willing to pay for this. And I thought accountants could do the same thing. Doctors keep us physically healthy. Accountants keep us financially healthy. We could be doing the same thing, and we'd have more pricing power, and we could have fewer customers, so we could make a bigger impact on the ones that we are privileged to serve.
And I love that because the definition of relationship is usually a two-way street, right? If a relationship is one way, we know in our personal life that doesn't go very
doesn't
far.
work. Right.
So if we're now thinking about a business model that's called a relationship pricing model, then it can't be just one way from the customer coming to us and asking for help. It has to go the other way too. I think that's the plussing value that we have to factor in, is how do we do plussing that goes back the other way? Do you have any suggestions on what can be considered plussing the other way to improve the relationship?
Yeah, I think, again, just like the DPC docs, make it convenient for your customer, make it frictionless. Don't send them out 200-page tax organizers, because you're meeting with them frequently enough where you would already know what life changes they have going on if they bought a house, got married, had a kid, whatever, that would change their tax return. So you want to give them convenience, you want to give them peace of mind, but most importantly, Louie, you want to have spare capacity at all times. So when they do call you and they need something by tomorrow, that you can handle it, that you're never running at more than, say, 60 or 65% capacity. And even that makes me nervous, because you always want to be able to drop everything and go see a customer if they're having a difficult time or they need you for something really important, or just to be able to make contact with them to help guide these transformations. And that requires a lot more time. The interesting thing about a relationship business like accounting and bookkeeping is relationships don't scale. Just like you said, they can't be one way, but they also don't scale. There's only so many people that we can have a meaningful relationship with. Now, I'm not saying that businesses based on relationships can't scale. They can. Some of these DPC docs have grown. They've added 3 or 4 doctors. They've opened up other offices. So they are growing, but each doctor can only handle so many patients. These DPC docs max out at 600 patients. The average doctor here in the States has a panel of patients of 2,400. So you can see that it's a huge difference. They've eliminated 75% of their patients, but the patients, the 600 that remain, get top-notch care. They get to spend an hour, sometimes 2 hours with every patient. Compare that to 5 minutes with your general physician, which is average. And you know what? That's why they entered medicine to begin with, and that's why they became a doctor. When you can only spend 5 minutes with somebody, the best you can do is solve their problem, what they presented with. You can't keep them healthy because you don't have enough time. We've got to stop kidding ourselves that we can have 500 customers or 1,000 customers or 2,000 customers, because we can only handle so many. But if we narrow it down, we can have a bigger impact on them. The bigger the impact we make on them, the more pricing power we have, but the happier they will be paying us a higher price, because they're getting a much higher level of a plussed experience. That's what's going on with my landscaper. I'm paying this guy 3 times more than what I paid all my prior landscapers, but he's giving me a better experience.
Right.
And therefore I'm a happier customer.
So I've got another question. One of the things in your book I was very impressed with, and I think it's one of the key chapters for me, was all on the knowledge worker chapter. Because what's interesting about our profession, Ron, is that we employ knowledge workers, right? It's all about type of people we employ is different from a traditional service or product-based company for the basic components, right? When it comes to trying to track performances or key performance indicators for a knowledge worker compared to traditional things, you said that we have to replace traditional tools with judgment. And when I read that, I'm going, how do I track judgment?
Right.
So
right.
I'm going, how does that work? If you can help me a little bit there, because professional firms, we have partners and managers, and who are they managing? They're managing knowledge workers. And particularly in today's reality of how scarce key employees are to find, give us a little bit of a hint or understanding of how can we get away from traditional measurement tools, which actually have a negative impact on our people, right, and their productivity, and go to what you call judgment. I would love to hear this.
Right. And this is one of the things that makes knowledge workers different than other types of workers, because in a knowledge environment, judgment is much more important than measurement. And I'm talking about judgments of the managers or the leaders, or judgment about the employees, just because I think we need to align what we measure or what we judge with how the customer defines our success. And we measure a lot of things, Louie, because we can and it's easy. So that's why we keep timesheets, and that's why we measure inputs, because that's very easy. It's much more difficult to measure somebody's communication skills. Sure, I can ask you on a scale of 1 to 5 or 1 to 10, rate Ron's communication skills, rate Ron's knowledge, rate his presentation skill, all of these things. Just because there's a number next to it doesn't mean that it was judgment that got you to that number. You're not really rating my skills. You've experienced them. How do I rate a doctor's bedside manner, the way they talk to me, the way they communicate what's wrong and explain what they're going to do and how they're going to, fix it or whatever? I experience that. I don't measure it. And if you look at what defines a successful accountant, bookkeeper, whatever, it's all of those things that the customer experiences: your communication skills, your bedside manner, your listening skills, your pride, your professionalism, your customer service ethic, your willingness to help your colleagues and mentor, and all of those things, your ability to deal with change. None of those things can be measured, and yet they are what define a professional, a true professional. A technician who cares is the definition of a true professional. And I can't measure that, but I can experience it. And so I think we need to use judgment. And the dirty little secret is we already are. We already know who our A players are and our B players and our C players. And if a C player doesn't improve, we're going to fire them. Now, my bet is we didn't fire them because they weren't billing enough hours. We fired them because we didn't like their attitude. We thought they were unprofessional. They weren't good communicators. They didn't have a good customer service ethic. Those are all subjective things. We need to get comfortable with subjective judgment, because that's what leaders and managers are paid to use. They're paid to make judgments and decisions, not just look at blind measurements that may not have any correlation with what it means to be a successful knowledge worker.
So you've hit a lot of things about what impacts value to the professional or for the firm. And all of these relate to customer interaction, and the ability to communicate is the key thing. One of the things in our profession is errors, right? So 0 defects compared to 0 defections. I thought that was a very interesting chapter, because it actually focuses on exactly what we tend to focus on. How many mistakes did our person make? How many times do we have to redo it? How critical is that compared to the deflections, which is really how many customers did that employee lose us, right? Or how many customers did we have to fix because that person did something wrong, which is a different metric completely. It doesn't tie into their overtime. It says, well, this guy keeps saving all our customers, but he has a lot of mistakes, so someone reviews them. Which one is more valuable? The one that has 0 mistakes and loses us customers because of his customer relationship component, or the one that has maybe more than average, but always is great at the front end?
Right. I would take the latter. I'd rather have somebody who my clients love. That gives us room to make mistakes. Now, that chapter is not an excuse to make mistakes. We want
I'm not saying that.
I don't, and I know you're not, but I just want to make that clear. I'm not saying make mistakes intentionally, but let's face it, Louie, this is a human endeavor, and to human is to err. We are going to make mistakes on books. Good thing it's not a life and death business like doctors or ER doctors or something like that, but occasional mistake is going to slip through. And I think one of the things that separates a great company from an excellent company is how they deal with customer complaints. If you look at a company like Ritz-Carlton, if anybody who is complained to at Ritz-Carlton by a customer, it could be the doorman, it could be a valet, it could be a maid, it could be the front desk, whoever hears the initial complaint owns it. This is part of their basics, their rules of ladies and gentlemen serving ladies and gentlemen is their motto, which I just love. So I complain to somebody and they own it and they have to make it right. Even if they themselves can't solve it, they may have to go to a manager, somebody higher up, whatever, but they own it. They have to convey it back to the customer, provide closure. Each person is allowed within the Ritz-Carlton up to $2,000 budget without getting any approval to take care of a customer complaint. And so that means they can comp your stay, they can get you an upgrade maybe to a suite, they can comp your next stay, they can buy you a meal, whatever it might be, whatever fits, they have up to $2,000 to spend without getting any approval. And when the founder of Ritz-Carlton did this, all of his peers that ran other hotels said, "You're nuts. You're going to give the maid authority to spend $2,000 to make a customer happy?" He said, "Listen, the average business traveler spends $100,000 in hotels over their lifetime.
Right.
Will I risk $2,000 to save that 100 so they keep coming back to my properties? I'll take that bet any day." And that just shows you that we're no longer concerned about the math of the moment. We're concerned about customer lifetime value. So with a subscription business, what you're really doing is you're building lifetime annuities that are more valuable than the cost to acquire them. And that's part of that long-term relationship and the long-term modeling that you have to do, because it's all about customer lifetime value. It's no longer about the math of the moment, the gross margin on that job, that customer. It's about those customer lifetime annuities. And that's what I mean by zero defections. You don't want to lose customers. Every customer that you lose should be a punch in the gut, like mine was. And I'm still reeling from, by the way. They already are a punch in the gut for even, I don't care if you're hourly billing. When you lose a customer, it's a punch in the gut. But it really becomes salient in a subscription model because those lost customers show up on your income statement under churn. There's a line item for them. You get to see it every single month. And if it's trending the wrong way, chances are it's going to force you to do something about it. So
before we go, because there's a bunch of other stuff I'd love to talk to you about on your book. And I would recommend everyone to pick up Time's Up because we only touched the surface of what's in there, Ron. As usual, there is a lot of information packed into very tight chapters that are fantastic. This is something, I don't know if it was created by some of the events that I saw you at when people would leave your things, we would get the Ron Baker headache. That's what we used to call it.
Yes.
So much information, my head starts to hurt. Like I said, there's the things that I wanted to talk about, but we're running out of time. So thank you so much for taking this time out of your busy schedule to help our readers know more about subscription modeling. And I think your book is going to be what your other book was on value pricing on this one. It's amazing. Ron, if there's anybody that can get a hold of you or want more information or even see you on your talk show radio host, tell them about it.
Well, thank you, Louie. It's been great. And I'm happy to come back anytime to talk more about this because I know there's a lot to this, but I don't want people to overcomplicate it. It's just a business model change. We've been through this before. If you move from hourly billing to value pricing, you've already done it. And by the way, if you haven't moved from hourly billing to value pricing, I do believe you can go from hourly billing and skip over value pricing right to subscription. And I think I've laid out the case for that in the book and how to do that. But people can find me on LinkedIn. I'm one of the LinkedIn influencers, so I have lots of posts up there and interviews I've done, such as this show and others where I talk about subscription and value pricing and a host of other issues. I'm on Twitter at Ronald Baker, and you can find me at thesoulofenterprise.com. That's the radio show I do, and that runs every Friday. It's a live radio show, but then it drops to podcast. So if you can subscribe to it on any podcast player that you use, again, that's thesoulofenterprise.com. And if you go to thesoulofenterprise.com/timesUp, we are about to launch probably next month, right around April Fool's, Louie. I don't know if that's coincidence or not.
That's actually a good time to launch.
Yeah, that's what I figured. We're going to launch the Times Up Club, which will be a membership for people that are really serious and want to make this transition. We're going to give you a platform and we're going to learn from one another as best we can. We're going to guide you through this transition. I have to say, with this business model, we are sliding back to that 2.5% of innovators, the first 2.5% that glom onto a new idea. And to me, that's the most exciting group to work with. The ones that are willing to take a risk, to be the pioneers, to take an arrow. And what will end up happening is exactly what happened with value pricing. These early pioneers will blaze the trail and they'll leave maps behind for the curious. And that's exciting to be a part of. So check us out at thesoulofenterprise.com/timesUp. And you can also email me at ron@verisage.com, which is V as in Victor, ERASAGE.com. And I'm happy to talk to any of your listeners, Louie, because in my mind, they're all colleagues. We're all colleagues, and we're all trying to better the profession overall. So happy to carry on the conversation.
Well, thank you, Ron. Thanks for being on the show, and thank you for watching us today. If you like this episode, please subscribe. And until next time, stay hydrated and be well. Take care, everyone.